Hey, welcome to the Exit Teams podcast, where business owners and their advisors get real practical insight on how to build a team of advisors, maximize value, and exit on their own terms. I'm your host, Bob Tankesley, author of Exit Teams, Build a Team of Advisors for Your Business Sale to Get a Higher Price. You can find that book and all kinds of content at exitteams.com. You can order that book off of Amazon. Hey, whether you are years away from selling or thinking about an exit now, this episode, I assure you, is packed with must-know tips to help you take advantage of opportunities and avoid costly mistakes. So let's dive in. Today, I'm joined by an expert in the world of financial statement auditing, Megan Meador. Megan is a partner at Brown Edwards and is lead of the manufacturing and distribution audit practice of the firm. She has over 20 years of experience in both public accounting and the private sector with both public and private companies. Before Brown Edwards, Megan worked with a national top five firm providing assurance services primarily with institutions regulated by the SEC, as well as other local manufacturing and for-profit clients. In addition, she has also previously worked for a publicly traded coal company in various accounting and reporting roles. At Brown Edwards, her focus is primarily on audit, assurance, and consulting within the sectors of manufacturing, mining, and energy, critical industries these days. She has also performed various consulting engagements for new entities, including opening balance sheet compilations and audits for newly acquired and formed companies. Hey, Megan, welcome. I'm super glad you could be on the show. You and I have a lot in common, and I've been really looking forward to this one. The issues we'll talk about today are just crucial because, quite literally, financial statements are the first way that I've seen buyers start to dig in when they're considering making an acquisition. And that's, I think at least, that's what makes this topic so important for sellers to understand so they can make a strong first impression.
Absolutely, Bob. Thanks so much for having me. I've been looking forward to doing this as well and having a conversation with you. And again, a quick introduction. I'm Megan Meador. I'm out of the Bristol, Tennessee office of Brown Edwards. Just real quick, Brown Edwards is a top 100 regional firm. We have offices throughout Virginia, a couple in West Virginia, and two in Tennessee, one of which is in Bristol where I'm stationed. So we offer all kinds of accounting and consulting services. We do have a website. I'd love for your listeners to be able to check that out sometimes. And again, I am the leader of our manufacturing and distribution practice, and we have our own little landing page there. So check that out at www.becpas.com.
Excellent. Yeah, y'all have a very robust firm. I know several of the partners and principals there just doing great work all throughout the Mid-Atlantic and the Southeast. Really strong capabilities there. Hey, let's start here with manufacturing businesses because I've noticed the owners of those kinds of companies over the years, they start thinking about preparing for a sale. They usually focus on, growing top line. They might, pay attention to their margins, especially if they've got, a firm like yours advising them, or maybe an internal, CFO level person, or they might be more of an operations type of leader. But as I said a couple of minutes ago, financial credibility is often what determines whether buyers actually trust the story. They tend to go to these financial statements first. So my first question is, what are some common audit deficiencies that y'all see in manufacturing and industrial-based businesses when they're preparing for sale? And why does that matter so much in an M&A context?
Yeah, that's a great question. And I guess I'll start with a little shameless plug that, you should always be, talking with your advisors, you have a CPA on board because readiness for something like this is key. It's very hard to come in, right in the middle of a possible deal going down or even right before and try to make sense of books and records and make sure they're clean. So, some of the things that I think are most important are a strong month end closing process, um,
Mm.
tight inventory controls, and then estimates. So those are some of the things I see, kind of right out of the gate that can be problematic when you're either thinking about a sale or going through, the due diligence process of a sale. So when you think about a monthly close process, the size of your company matters, of course. And, segregation of duties and small accounting departments are prevalent, especially in our area. And, what I say is that's okay. You can only do so much. One person can only do so much in a day. There's only so many hours in a day. But, systematically thinking about the pieces of your financials that are important while you're closing your books on a monthly basis are going to be key. Are you cash basis or are you accrual basis? Most
Right.
of these deals, are they want GAAP basis financial statements. And so sometimes that can be a little tricky right out the gate if you're keeping your books on a cash basis. I'm sure you've seen that as well on your side.
Yeah. In large, I'm surprised. I'm continually surprised. I get a hold of some financial statements and they're still on the cash basis. And guess what? Top line revenue is 20, 30, 40 million and higher. And I just want to say you need to move to GAAP. Your
Yeah.
buyers are going to be concerned about this. Can we get there? Yeah.
That's right. And sometimes that takes some digging and it takes some, researching, but I think that's important. Most of these deals I see, I have not seen one that's not GAAP. And so that's an important hurdle. And so, let's have this conversation just, continuing to think about that we are on GAAP, but AR, making sure your accounts receivable are recorded properly, making sure your AP is recorded properly, like all of that's usually pretty vanilla in a closing process. Running depreciation expense, thinking about that. Some things that oftentimes get left off are, your prepaid expenses. Are you amortizing those the way that you
Mm.
should? Are you thinking about, especially with manufacturers, they have warranty accruals. When you're doing some kind of high level, top level estimate like that, is that supported by something, which usually involves somebody outside of accounting, not somebody like you and us. It's you and I. It's somebody, on the shop floor that's like, yep, we sold that, but we told the customer that, in 6 months, if it fails, we need to, replace whatever the situation is. So, are those folks talking to accounting and you're building a strong estimate for what your warranty liability may be? And an accounts receivable reserve, if you're on, GAAP basis, are you thinking about the collectability of those receivables? Are they going to come through? Are you going to be able to collect them all? Our economy is not today what it once was. So thinking about the future collectability of that revenue is going to be important. And then, obviously, most importantly, in manufacturing anyways, is inventory.
Yes.
I could probably talk about this for the rest of the podcast,
Take
but
as
I
long as you need.
won't. But
It's a perennial topic. It just keeps coming up.
it is, and things that seem so simple can be so very complicated when you're first starting this if you don't have the correct processes and controls in place. And a lot of it is just counting inventory. Do you have a good perpetual list of what your inventory is? Buyers and potential buyers want to know that. They want to know, does all of this exist? Is all of it sellable? And is
Yes.
all of it, like, how is it costed? Like, that's very important. Um, not too long ago, I was approached to audit a company that was looking to possibly go to market, and they hadn't done an inventory observation in 2 years. And
Ooh.
there was some things on the list that didn't exist physically. And so we worked together to make sure that, they had a list. That list was supportable by SKUs or item details or whatever you want to call it, and quantities. We had to weigh count some of those. We had to each count some of those. We had to length count some of those, but making sure that those were supported. And then we also had to talk about how they were costed. Is it based on an invoice? Is it a raw material product that's based on invoice cost? And as it moves through the process, GAAP requires you to apply your overhead rates. And, how is that conducted at each company? And is that costed correctly? Your buyers are going to want to know what that looks like on your books.
I'm so glad
So,
you put it that way. Yeah.
yeah. And so, again, if you're right in the middle of a deal and you're trying to get all of this stuff, handled and correct, that's very daunting. Doing that early, and I'm going to suggest even 2 to 3 years early.
Okay. Thank you. Yeah, I was going to ask you that next.
Yeah.
How ahead of a transaction, how early, how far back would you like to be involved?
I usually suggest 2 to 3 years.
2 to 3, yeah.
And the reason is because, your auditors and even your buyers are going to talk about beginning balances, and they're going to talk about fluctuations, and they're going to talk about, what it was your margin this year versus last year. You've got to have that data, and that data needs to be correct and reliable in order to build that history.
Yeah. I've kind of landed on that 2 to 3 year time frame as well. It does at least two things. Number one, it proves to your future buyer that any changes you've made in the company, recommended by a good CPA firm, recommended by other types of professionals, it proves to your future buyer that the changes you've made are sticky, that they were in place long enough, and that increases their confidence that those positive changes are going to remain when they become the owner of the business subsequently. The second thing I think it does is 2 to 3 years is not so long that you're going to burn out your owner. You're asking them to make all these changes, asking them to adjust the way they do things in their company. If we could just hold their attention and make these improvements over a 2 to 3 year time frame, we can accomplish quite a bit.
Yeah. I mean, some of the things we suggest, and again, it depends on the size of the company and what you're manufacturing, obviously, but sometimes implementing cycle counts after you've done a
Okay.
strong physical count, and you kind of know what you have and you have a good list. Cycle counts can be pretty effective. And, it puts the responsibility on your, production personnel. If they're cycle counting and they know they're going to cycle count, it gives them more of a feeling that they should report scrap or, their receipts and their uses correctly throughout the year. And then it also involves accounting at the right level. So you're kind of adjusting everything as you go on a monthly or quarterly basis versus doing it all at once at the end of the year. So
If
that
you're
can be an effective way.
sure, and if you're the more frequent, the better. Uh,
Yep.
you end up giving internal management this loop of information that you don't have to wait till they receive large year-end adjustments to know how operations are going.
That's correct. That's correct. And, talking about again, the financial metrics that you're looking at, cost of goods sold, when you're talking about profit margins, your inventory needs to be costed correctly in order for those numbers to be reliable, obviously. And those are the numbers that your buyers are looking at, right? Like, what's your gross profit margin look like? What do your EBITDA numbers look like? And so the more reliable that your inventory values are reported, the more reliable that those values are going to be for your potential buyers.
There are audience members that are listening that are running companies, manufacturing, distribution companies, energy, mining, that kind of thing. Can you, and let's say they haven't had a financial statement audit yet. Can you walk them through, what a typical audit might look like? Because I know some owners, they hear the word audit, they think, oh, this is going to be painful, and there might be some adjustments for sure. Hopefully, they're not thinking it's going to be an IRS level audit, with some kind of punitive result on the back end. But you're trying to come in and quite literally get their financial reporting to a better state. So what can you say about the audit process itself, start to finish? What does that look like when you guys go in?
Yeah, I mean, so you can have scary audits and you can have, audits that are actually meant to, benefit you. And to be frank, those are my favorite types of audits. An audit is a scary word. It's really interesting to try to explain to my children what I do for a living, but audits are not necessarily always meant to be like the get you factor, So the way I normally start an audit is, give me your financial statements and let's talk through, audit, of course, does have materiality thresholds. We're not there to nickel and dime. It's a different mindset than preparing a tax return. But, we're there to make sure that your numbers at the end of the day are supportable. That's all an audit is really
Right.
trying to do. So when you look at, let's walk through, for the sake of this conversation, let's walk through some of the big ticket items. Accounts receivable would be one of them. Do you have an AR aging? And sometime after year end, either, usually 30 to 60 days, have you collected on those accounts receivable? Normally that's on a sample basis, but that's really the gist of what we're trying to accomplish through an audit is that AR valid. On cash, do you have, does that reconcile to a bank statement? Inventory. I always talk about inventory as quantity times cost. And so if you get comfortable that your inventory exists, how is it costed? And again, that usually can be a sticky point depending on the history of how things are being costed. A good auditor, again, a little shameless plug, I guess, will help you through that process. It's not meant to be a get you factor. It's meant to be in compliance with the guidance of US GAAP. And so is that costed correctly? Are your fixed assets supportable? Are they, do they exist? Are they busted? In the mining world, stuff goes underground sometimes. Like, is it
Sure.
still there? Is it usable? Um, and then just quickly going down through the balance sheet, your accounts payable, do you have a good listing of what those are? Do you pay your vendors on time? Debt, is your debt recorded properly, including all of your accrued interest and anything you might owe the bank. So it's really not meant to be a scrutinization exercise, but really are your balances supported? And by issuing that audit opinion on top of your financial statements that you can hand to somebody that's looking to purchase your company, that's invaluable because they know immediately that those numbers are reliable.
Yeah. How about we hear this term often. We hear buyers requesting um, quality of earnings reports. We're starting to hear sellers that want to get ahead of that and have some kind of sell side quality of earnings, known in the industry as Q of E. How is that for again for owners who haven't had a financial statement audit yet, but they think they're going to have a request for some kind of Q of E? How can they get ahead of that? What does a quality of earnings report process look like?
Yeah, quality of earnings is somewhat different than an audit in that the information that you're handing over is not necessarily verified. Now, they're going to ask you a lot of questions, and probably the feeling of that quality of earnings may feel a little bit like an audit.
Feels like
They're
one,
just,
right?
yeah, they're just not going through the verification process, like tying it to support or invoices or a register or something like that. But the Q of E can be sometimes, just as in depth as an audit. Q of E's normally an audit. I feel like an audit is usually annual. Q of E's I've seen them be monthly or quarterly. And so they're
Mm.
really diving
Wow.
into like those, what does that look like on a monthly basis? Are your monthly financials correct? What are the segments of your business that may be profitable or not profitable? That's something that a Q of E will look like versus an audit is usually on a consolidated level. And
Yep.
so, but they're going to ask you the same things. They're probably going to disclose a lot of the same things. It may be a touch lighter than an audit, but again, they're not really focused on the validity of the data underlying. They're more looking on, a future state, earnings forecast, if you will, on the data that exists. Does that make sense?
It does. Yeah. And I've always kind of thought of Q of E reports as helping buyers do due diligence on the business. Here's a level of analysis. Here's, not like you said, not assurance, but here's some extra work that's been done that really can shorten the time frame from a buyer in terms of a buyer understanding a company. And once buyers or private equity firms start to do that due diligence, let's face it, they're looking for signs of both reliability and risk. They're trying to figure out what happens to this company when we step in as the new owners. So that leads me to think about what audit or financial reporting red flags tend to raise the most concern for buyers or PEGs, private equity groups during due diligence.
Yeah, that's another good question. I think the most common things that I see or have seen so far in this process are inconsistencies.
Mm.
Um, and so again, the more reliable that your data is underlying these analysis or the audit the better outcome that you're going to have in order to answer some of those questions. Inventory problems can kind of shine a light pretty quickly. I was involved not too long ago on picking up some work for an opening balance sheet, a compilation that then turned into an audit. And the margins changed kind of overnight. And that's because the inventory costing changed overnight. And so being able to dig into that to understand what that looks like, is that correct under GAAP? How do those inventory changes affect your margin numbers? I mean, that's key. The other sticky thing can be tax situations. Are you solid on, your nexus and your states? Do you possibly have transfer pricing issues? Do you possibly have, regulatory issues, environmental issues, anything like that could be a tax red flag.
Mm-hmm.
That could also be an opportunity though, such as a cost segregation study. And, I don't want to go into too much depth on some of those things, but, buyers are looking at that stuff. Like, when is how can I make the most money? That's what we're trying to do at the end of the day.
That's a great point, and that leads me to my next question. That is a fantastic point because sophisticated buyers, and let's face it, private equity groups, you could easily put them in that sophisticated buyer category.
Absolutely.
Strategic buyers, sometimes family offices, they're all bringing all these institutional level buyers. They're bringing teams of analysts and professionals into an engagement into a company that they're examining. So one of the recurring themes that I've seen over the years is that owners wait too long to call it professionalize their reporting and their audit process. They keep pushing off the need to have someone come in. What we talked about, the 2 to 3 year mark of of bringing somebody in. What kinds of changes can be made in a business to the financial statements, to the reporting process that can increase buyer, call it buyer confidence when they step in? Because let's face it, these buyers are taking a long time. They're taking longer, I've noticed, to get through due diligence.
Mm-hmm.
They might have been spending the last 3 to 5 years determining what kind and what individual companies they want to put in their portfolio. So they're really good at what they do. And I've been trying to get owners to think like a buyer. Shouldn't you spend at least 3 to 5 years to get your company ready for prime time, for sale? Because these buyers are they're getting they're getting they're getting a lot more granular in their due diligence. What kinds of improvements can be made in a company over those 3 to 5 years that can impress future buyers?
I think ensuring that you're taking that runway to do what you should do with your books and records. I mean, that's what they're going to look like. That's what they're going to look at. And again, I hate to keep harping on inventory, but in my world, that's usually what we're looking at. And so, are you selling good stuff? Do you have, when you look at your property, is it organized? Does it have scrap or trash laying around? Do you have a bunch of manual entries that you're having to go in and make? Or are you letting your subledgers kind of do the heavy lifting for you to where your process is running, pretty
Yep.
clean on a normal basis? Or is there a lot of extra effort happening on the backside to get your books right? And sometimes, you hate to say it, but these sophisticated groups that come in, these PE groups that come in, they know usually very quickly where they can start cost cutting themselves. I mean, that's just how this works, right? And so, they'll know if a process is harder, not smarter, and they're going to try to figure out how to make that smarter, not harder immediately, because they're going to
Yes.
cut costs. So if you can figure that out on the front end and that, that leeway up to, the point that you want to buy, you're going to multiply, how much you're going to be able to get from your sale. And again, I'm not here to sell an audit. I'm here to inform. But going through that process early, can it be expensive? Sure. But it's also going to provide your buyer with a lot of confidence in what you're doing. And again, your auditor is also meant to help, where can we take something and instead of, digging into an estimate to try to get it correct, where can we come way up out of the weeds and just book a blanket accrual, or where can we estimate something that would make this a whole lot easier? Because again, when your buyer comes in and they do their due diligence and they ask the right questions, which these sophisticated groups are going to, they're going to quickly figure all of that out. So taking that runway, that 2 to 3 years to try to get your processes solid, again, that's going to pay off, in multiples of the return. That's what I think anyway.
That was very well put. I'm going to ask my tech team to make what you just said a short, as they say. That was fantastic. We're going to try to get that a lot of exposure. That's about as well put as I've heard it over the years um, of talking with people in this accounting world. In
Can
essence,
I,
you're the business owner's partner. And along the way, as I say constantly, you're helping them think like that future buyer. Yeah, there's fees attached to have somebody help you along that journey, but where are there not fees attached when you're trying to improve a business? Um, you can grow the top line, that's great, but it doesn't solve all the problems. It doesn't solve all the ills. I've noticed companies, uh, they might have a great $20 million top line revenue, but their margins are so thin, and that company ends up, as you talked about, improving margins earlier, that company ends up selling for less than the one that grosses 15 million but has industry beating margins, in margins much higher than its industry average.
That's right. And I think that's where your Q of E really does become important, because at the end of the day, what are they looking at? They're looking at the customers that you have relationships with that are driving that revenue. And
Yep.
they're looking at the cost of your product that are driving what that margin looks like. And so Q of E's do help with that. And then again, the audit will help solidify that the numbers used are correct. One of the other things is that we see often when you talk about revenue is revenue cutoff. Thinking about, especially these days, we're shipping stuff everywhere. Do you have tight controls around what that would look like for your company? Sometimes if you're shipping something large, it's easier to kind of nail down what that revenue cutoff looks like and if it should be recorded in 2025 or 2026. If you got a lot of little stuff going out the door, that can get pretty complicated pretty quickly. That's another thing your audit's going to cover as well.
Yeah.
Being able to rely on that revenue number for the year.
Oh, the infamous year-end cutoff adjustments. Who gets to claim credit for it?
That's right. That's right. And it can be to your point, it can be painful at times, but it's worth it in the end.
Yeah. Let's talk about teamwork. The Exit Teams podcast, the books, the Exit Teams book. The firm name is Exit Teams. The website. Everything I do is I talk about teams. I talk about building that collaborative team of advisors around the owner sooner rather than later. I've noticed a successful transaction usually requires alignment between multiple advisors, not just anyone working in a silo independently, but maybe the same heads in the room or on a Zoom call, but we're debating issues, we're talking about strategies and possible different outcomes. So I've got a question for you about how you and I can work together. How can auditors broadly and M&A advisors work together more effectively to help a business prepare for a transaction?
Yeah, I'll give a response and then I think, Bob, I would be interested to hear what your side of the response would be as well. But
Yep.
we always say, not just your M&A advisor, but your accountant and your CPA should be talking to your lawyer, and those two people should be talking to your banker, and there should be no secrets, because at the end of the day, we work for our clients.
Yep.
And although yes, we all have to pay taxes, our job is to make sure that you're paying the lowest tax that you have to, you know?
Yeah.
And so understanding as well what your banks require with debt, you know, if for any debt that would be either satisfied or entered into, you know, what your buyers and your sellers are looking at. I just think having open conversations and get aligned early on what the buyer is most likely to put their teeth into. So, what are
Yes.
we worried about? You know, let's talk about that. Let's work through that. You know, having honest conversations about that. You know, Bob, I'm sure you see it that you're very familiar with that business. You know where the problems are. So like go ahead and tell the auditor if you're, you know, if you're going to find something, let's start right here. Let's not wait until, you know,
Yep.
months down the line when we're completing the audit that the auditor's finding like an uh-oh. Let's talk about it now because our job again is to help solve that problem to get to the right answer. It's not to get a gotcha. It's to get to the right answer. I also think that it's healthy to talk about, you know, things like customer concentrations. You know, where are the major, who are the major customers of this business? What kind of CapEx needs are we talking about? Like talking about
Mm.
the future state of the company and their accounting needs, maybe some tax credit needs, all of those things talking together, all of the advisors talking together is very, very important. Estimates is another example. Um, the sensitive topic of bonuses. You know,
Mm.
lots of times when you've seen this, I'm sure. If you're getting ready to buy a company, they normally don't want you to pay big bonuses the year before, but they're going to help you out when the deal closes. So let's talk about that. Let's take care of your employees. Let's take care of the seller and make sure everybody's being, you know, taken care of at the end. Um, just looking at some notes here. Just, you know, again, where is your buyer potentially going to find some problems or increase their scrutiny on an area? We need to talk about that early.
That's fantastic advice. I've been using the term kind of a core deal team, and you hit, all the ones that I consider: CPA, banker, attorney, evaluation person, M&A years in advance, kind of help guide the conversation or input into the conversation as well from a buyer standpoint. Because when an M&A person takes one company to market, they end up hearing from multiple different buyers, 10, 15, hopefully not 20, 30, or 40 different buyers. Hopefully you can get the company sold before it gets too far down the road. But you're right. Um, get ahead of these issues that we know this buyer pool is going to object to if we don't fix them. Fixing these issues and these problems long before any future buyer has a chance to raise them. And that only happens, like you said, in a collaborative way.
That's right. And I think, you know, the other thing that gets very sticky in a lot of these deals, you know, that I've seen too is vendor relationships and employee relationships.
Mm.
Um, you know, I think I shared with you before that my husband was a part of a strategic group many moons ago that basically were taking the mom and pops and then sourcing them to the Walmarts. That's similar to what a PE group is probably going to do very quickly after they purchase a company. I mean, they are
Owners
there
need
to
to know
get,
that.
and
They need to
owners need to
know
know
that ahead of
that.
time. Yeah.
Yes. And we need to be open with about that, you know, and if that's important, that's important. And usually there's side deals, there's handshakes that happen, there's agreements that happen during cocktail hour on a Thursday night. And so your financial support professionals, you know, your lawyers, your CPAs, um, your brokers, they need to know about that kind of stuff so that we can best protect and help.
Yeah. I like how you put that a few minutes ago, and that was something to the effect of if you know your private equity firm buyer is going to do all these things to your company, make all these changes, improve it, operationalize it, financialize it, streamline it, um, as I say, optimize it. Do that ahead of time. I tell
Mhm.
owners all the time, if you've got time, money, the right people, and your own health, make these changes, while you can.
That's right.
And as you said earlier, the multiple will go up.
And the other thing that you can do while you're doing that is think about, an EBITDA versus an adjusted EBITDA. And so
Yeah.
lots of times if you track these charges and you're like, well, yeah, I spent this money, but it was for this effort. It really wasn't for the cost of continuing my business. Separate those costs out and you can report an adjusted EBITDA number. And usually you get, let's call it forgiveness on that number. I mean, I'm
Sure.
sure you see that all the time.
Uh, I don't know what you're talking about. I've never seen an owner run personal expenses. Now, for those listening or watching, of course we're talking about the boat, the plane, the multiple cars, the vacation home, the kids' college, all that stuff
That's right.
that we sometimes see. We love our business owners, but they do need some help, especially those last 2 to 3 years.
But it also could be, it also could be, an employee finder, one of these people that a job placement agency,
Yeah.
that can go sometimes as adjusted EBITDA because just an outside of the box, a legal fee that you're,
Mm.
even a CPA fee that you're paying that's not really a part of running the normal course of business, you can sometimes call that, an other expense and put it below the line for your reporting. And again, your buyers want to know that you're spending money for the betterment of, continuing the business, although it's not directly related to the business. And sometimes that can make a difference. So it's worth it to kind of keep track of what those costs are and communicate what they are.
Yeah. Yeah, there's a running theme through our conversation here. Transparency early and often.
Mm-hmm.
Just put it out there.
Yes.
Speaking of which, a lot of owners think about audit readiness as just pure compliance, just something they have to put up with. But in reality, it can directly impact their leverage. It can improve buyer confidence and ultimately valuation. What is something that you wish that more owners understood about the connection between audit readiness and deal value?
Yeah. An audit, unfortunately, usually is always, backward facing. We're going back in time to deal with something. And that's unfortunate, but that's just the nature of what it is. Once you get that rhythm of your audit, lots of times it can be
Oh,
forward thinking, and so
there's some real truth to that. It's like, oh, I don't want to get caught, I don't want to go through that process again. I don't want to have to make all these adjustments again. Yes, I'll get into compliance. We'll start doing things better. And that then flips the switch, not just in the owner's mind, but a lot of people throughout the company. They start looking for other ways to do improvements to
Mhm.
the business that, an audit may or may not be designed to catch. They start thinking more about the future. So in a way, this self-correcting or this correcting loop ends up having future benefits, not just correcting the past. I like that.
Yeah, I mean, and it's true. I mean, and again, the audit in my eyes is not meant to be a getcha. It's just kind of meant to be to implement some diligence and some good practices. Of course, internal controls in an audit are wonderful, but you're exactly right. If you're doing these little schedules or whatever it is that's required for your audit, maybe not every month, but maybe every quarter, and maybe you're
Yep.
catching some stuff. Maybe you find, a prepaid insurance balance that's hung up on your books from 2022, and nobody's ever expensed that off. Maybe you're finding some old checks outstanding that should be turned in as cheap. I mean, I don't know, the
Sure.
possibilities are, crazy, but I think just thinking about that an audit doesn't always just have to be a terrible thing. I mean, it's not lovely. It's not a dream come true, obviously, but if you can also discipline yourself to think about, how can I make my books internally better to make my audit run better? That's going to be better when you're thinking about a sale.
Yep.
Um, even silly things. I was working with a company not too long ago, and they had a humongous receivable from a related party. So we
Okay.
were going through the audit, and I was like, "Hey, can I see the agreement for this?" And they were like, "Well, we don't really have one." And I was like, why would you not have? I mean, we're talking about millions of dollars here. So, think to yourself, like, what is an auditor going to ask for? My possible buyer is also going to ask for that. You need an agreement. So again, get your auditor, connected to your lawyer, connected to your banker, and that's just going to make everything better. Within about 3 months, they had it all papered and we were fine. But, stuff like that, thinking about related party relationships, thinking about situations where you don't have agreement. Leases can be a nightmare when it comes to a manufacturer with multiple locations
Yep.
where folks have the authority to do whatever they want. I mean, that's real life. It happens. But, oh yeah, I see this lease expense now coming in my income statement for a forklift that somebody rented. Do you have the lease agreement for that? Your auditors are going to want to know that. So these strong monthly closes, reviews of your financial statements are really going to help prepare for that and just, create some good habits for closing your books.
Yep. That's all very well put. That's probably a great way to sum up our whole conversation, Megan. This has been fantastic. Where can folks get a hold of you to hear more about you and the team at Brown Edwards can do?
Yeah, absolutely. I would love to chat with any of your listeners about this. I never really saw myself as an auditor, but I do love the consulting side. I love to help manufacturers. I've been, in a controllership role in my past. I understand what it's like to close books. I understand what it's like to not have any employees. Excuse me. I understand what it's like to be stressed out by, somebody looking behind your back. And so if you ever want to reach out, you can find me on our webpage on www.becpas.com under our manufacturing little tag area there. It has a direct connection to my email and phone number. Please give me a call anytime.
That's excellent. And folks, remember, an audit doesn't have to be a terrible thing. I'm quoting you from what you said a few minutes ago. It can also be a very forward-looking and business improving thing that I do recommend everyone do before they start going to market. Well, that's another great episode of the Exit Teams podcast. A big thank you to my guest, Megan Meador, for sharing her expertise and insights, especially when you consider that excellent financial reporting can literally make or break a business sale. I don't think that's an overstatement. So if you run a manufacturing or distribution company and you need to upgrade your CPA firm, I suggest you reach out to Megan and see how she and the team at Brown Edwards can help. If you're a business owner thinking about your next chapter, now's the time to start building your advisory team. You can learn more in my book, Exit Teams. Build a team of advisors for your business sale to get a higher price, available on Amazon. And don't forget to visit exitteams.com for free resources, tools, and insights that can help you prepare for a successful exit. Until next time, build your team, sell smart, and take control of your future.